Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and finance. This week, a North Atlantic economic crisis. But what do Europe and America's woes mean for the rest of the world? We seek some answers from the man who runs one of Africa's biggest banks. And Beijing's up in arms with Washington's handling of the crisis, but it does keep buying up US bonds. So what is China's game now? And with all the market turmoil, gold's having a great time. We're in Thailand, where the demand is so high, it's outstripping the supply. So welcome to a special edition of Counting the Cost with our own in-house analyst this week. I'll tell you more about him in a moment. But first, we are looking back on what was quite a crazy week, really. It started with a historic decision to strip the United States of its AAA credit rating and turned into one of the most roller coaster weeks for global stock markets, down as much as 20% and wiping almost $7 trillion off the value of stocks. Then the Federal Reserve said don't expect any major improvement for a couple of years and indicated it would keep interest rates low for the same period. And then to top it off, still no strong political leadership from the Eurozone and a forced move from the European Central Bank to buy up Italian and Spanish bonds. All in all, a North Atlantic crisis, but one that has enough clout to damage economies globally. Here's a quick, simple snapshot. The United States, the world's biggest economy, $14.7 trillion is the sum total of all its goods and services. The European Union, the biggest trading bloc, comes in at $16.2 trillion. So those two combined make up almost half the world's total GDP of $62.9 trillion. The key here is that those are such important markets for Asian goods. And let's not forget Africa with its wealth of natural resources. Which is where we're focusing this week, the effect of these essentially European and American problems on the rest of the world. Yes, they affect stocks, and we've seen plenty of that on the markets, but it does, of course, go much deeper. And to help us out this week, I'm delighted to have Ali Khan Sachu joining us here in the studio. Ali, a familiar face to regular viewers of Al Jazeera English. He's usually in Nairobi, of course, where you run your business and website, Rich Management. But here in Doha this week to help us sort through the world's financial problems. So welcome to you, Ali.
Thank you for having me on your show, Kamal.
So we're going to start with a report from China, actually, and then get some of your opinions, because China, in the wake of this US downgrade, has continued to cast doubt and indeed pour scorn on Washington's handling of the debt crisis. Didn't hold back in its language. Have a look at this from Xinhua, the official Chinese state media, which said since the collapse of the Soviet Union, the United States, as the world's sole superpower, has relied on its powerful military to meddle everywhere in international affairs, advancing hegemonism and paying no heed to whether the economy can support this. But remember, China has more than $3 trillion in reserves and about $1.2 trillion of that in US treasuries. So it may continue to criticise, but A, it has no option but to hold US government bonds, and B, it's kept buying them even after the downgrade. This from our Beijing correspondent, Melissa Chan.
China's central bank holds $1.16 trillion in reserve. So what's happened in the past few days has prompted anger here as Beijing watches the value of its holdings drop. State media published a scathing commentary over the weekend saying, quote, China, the largest creditor of the world's sole superpower, has every right to demand the U.S. address its structural debt problems and ensure the safety of China's dollar assets. It also warned that, quote, the days when Uncle Sam could leisurely squander unlimited overseas borrowing now appear to be numbered. Though some economists point out this is all political posturing. Watch China, they say, and see what it does in 6 months.
China just doesn't have that many attractive choices. It could decide not to accumulate any more reserves, but that would mean that essentially it would let the renminbi float.
I'm standing in front of the Chinese central bank, the bank in charge of purchasing U.S. Treasury bonds. There's probably very unhappy people in there. But as angry as China has been over the past few days, this has also been a fantastic opportunity.
To give the United States a scolding, something unthinkable just a few years ago. We're at Dagong, China's top credit rating agency, which had long ago downgraded the U.S., once in November and again just this month.
The U.S. economic model has become problematic. It has been borrowing based on future growth. America has come to the end of the line. It's selling bonds that mature 50 years from now, or even longer. It's consuming wealth from 30 to 50 years in the future.
This has become an opportunity for the emerging power to criticize the superpower. It likely won't stop anytime soon.
So let's pick up on these issues to do with China with Simon Sol. He's Chief Executive of Exclusive Analysis, joining us from London. And of course, Ali Khan Satchu with us here in the studio. Simon, I'm going to start with you. All this negative talk coming from China towards the United States, what do you make of it? Does China risk coming off as almost kicking America while it's down, just taking advantage of the situation?
No, I don't think so. I mean, China, of course, the biggest lender to the United States. China very nervous about its investment, but maybe more important about the continued kind of health of its main market. Chinese ratings agency downgraded America bonds over a year ago. Our people in China, people we talk to in China, say no, they don't want to dump the dollar. That would lead to greater chaos than now, although they probably stopped buying it. And they think there are other places they can put their money for greater return. So I think China's taking personally a fairly reasonable position in light of the fact that it's the biggest lender to an economy that's shown very little appetite to live within its means and reform its finances.
Exactly, because despite downgrades from Dagong, as you point out, and the S&P downgrade we saw, China is still in a position where it is buying up US bonds. It hasn't got too many alternatives.
That's right. I mean, China's been trying to find alternatives for some years, and we noted a concerted effort last year to try and find alternatives, but there simply aren't any. And also, secondarily, they do need the US economy to maintain a certain state of health to buy Chinese goods, and their own internal economic well-being and social stability depends upon that. So they're caught with their hand in the mangle, as it were, because they're dependent on a foreign market they can't control, and in which they're not particularly welcome, but they are dependent on it.
We'll bring Ali Khan Satchu into the conversation now. What do you make about this idea of alternatives? Are there any alternatives?
Well, I saw that the Chinese were exploring all kinds of alternatives. I saw a report that SAFE was looking at Australian and New Zealand assets, and you saw this enormous rally in the Australian and New Zealand currency. The New Zealand currency and the Australian are at post-float highs, and I think that was a signal and a sign that the Chinese were investing a great deal of money in those Antipodean assets. So whilst I understand that the Chinese aren't going to go and dump the US assets they hold, I think they are clearly looking for other opportunities to diversify, and I think it's a wrong assumption to assume they're forever going to be buying US bonds.
Simon Sol in London, let me come back to you. China did a lot of bailing out last time we had a big financial meltdown. This is a bit of crystal ball gazing, but do you think it will be doing the same again this time if we are headed down a very negative path, as it seems?
No, I think that you'll see much less bailing out. I think you'll see China looking for alternatives, as was just discussed. I would highlight brands. I mean, China has consistently been trying to move up the brand chain and asking itself why it produces an item for, say, $20, which then gets sold on the Western High Street for many multiples of that. And so some of the people we're talking to in China talk about the appetite China has to buy some of the big Western brands and therefore benefit from the brand uplift in value, which, you know, that's a bailout, if you like, of brand companies, but China will bail out those companies that it can benefit from. I mean, the other thing we hear is, we China don't mind particularly about Greece one way or the other, although we'll buy things if they're cheap. Why shouldn't they? China is quite clearly going to use its capital for its own advantage. If assets become cheap for it, yes, they'll buy it. But I don't think they'll be doing any kind of altruistic bailout.
Seeing as you've started bringing Europe into the conversation, let's head down that path, because I did want to sort of look at China and Europe together. Earlier in the year, we saw China buy up Spanish bonds, Portuguese bonds as well, which perhaps, and maybe you can give us a European perspective on this, illustrates part of the problem that it has had to, or anyone has to, look at buying up the bonds of individual countries. Is the time right to start thinking about a proper European fiscal union where we look at Europe as a whole, we buy up bonds as a whole, we look at debt as a whole, rather than these individual countries which have caused problems?
Well, I don't want to go all sort of political theorist on you, but one has to deconstruct that question. If the question is very, very fair, proper question, is it a question about for the greater good of all should this happen? Probably yes. Is it likely to happen, given that actually these decisions are made by segmented players? I think very unlikely. And essentially, fiscal union, which you rightly say is the sort of necessary condition for that for Eurobonds to work, it's an ugly process, and I think people forget a couple of things. Firstly, it's very, very hard to cut national budgets. And so whereas Greece says it'll do this, Italy's just said they're going to do something else, they actually haven't delivered yet, and it'll be very, very hard for them to deliver, and the German voter knows that very well. Secondly, ask any department anywhere in the world, in any government, if you set the budget, effectively you decide the content. UK Treasury tell a department how much money they've got, but they don't let them to then go away and get on with it. They actually get intimately involved in the detail. So what that means is that, quotes, German bankers going to Greece and Spain and Italy and telling them which tram to close, which school to close, and that's politically very, very difficult. So I think when people people need to think about the detail of fiscal union and understand just how very, very high the political bar would need to be to achieve it.
Ali Khan,
Yes.
the theory's good, basically, but putting it into practice.
I think it's going to be very difficult to put into practice, and that's why I think there's so much pressure on the European project as we speak. You've got a whole bunch of different countries with different agendas, and it's very difficult to get everybody speaking in one voice. Just getting back to your China point about Europe, I think, and the world, I think if you want to know who has the dollars, it's HU. And at the end of the day, I think they're going to be essentially the bailout bank for the world. And they're not going to do it on an altruistic basis, as Simon said, but every time, you're going to get these crises, I think you're going to see the Chinese government essentially being the first port of call, as they were with Greece as well. So I think the way out for a lot of these European countries is going to be a sort of massive sell-off of state assets, and essentially the people who got the money are the Chinese, and they're going to look to come in on that point. That brings a political issue up like we had with the Japanese a few years ago, but that's somewhere down the road at the moment.
Ali Khan, thank you for now, and also thank
you
you to Simon Sol from Exclusive Analysis joining us from London. All right, so China's reaction forms a major part of how Asia is and may yet be affected by the US credit downgrade. We want to switch our attention to Africa, though, and apply some of the same filters to that continent. And we're going to do that, first of all, with Jacko Murray. He's the Chief Executive of Standard Bank Group, joining us from Johannesburg. Jacko, thank you for your time. Before we get going, I want to put our viewers in the picture with regards to your bank, first of all. Standard Bank, the biggest bank by assets in South Africa, 20% owned by China's largest bank, the Industrial Commercial Bank of China, operating in 17 African nations as well as 13 other countries. The point I'm making is that you are very much, though based in South Africa, very much an international bank. So in this global market, how have you been performing with your exposure to the chaos in the other parts of the world?
Well, there of course have been stock market impacts. Our stock market is down, but nothing like you've seen in some of the other markets. But we of course have had an impact on share prices. But I think South Africa as a country is in good shape financially. We haven't got any debt problems and so on. So no big issues directly on South Africa, no big issues directly on Standard Bank. As you say, we operate in many markets. But I think it's going to be the aftermath that really is important for us. But we are a global bank in many ways, with links into China and Russia and Brazil and so forth. But mostly developing countries rather than the countries that have been affected most directly.
What did you mean there when you said it's the aftermath that's important? The aftermath of what exactly?
Well, I think. We saw it with, if you will, the first global financial crisis, that we weren't directly affected. But of course, as growth slows down and you find that people pull in their horns, there are lesser flows into countries, that's when we get impacted. So it was much more what happens as a result of what's going on right now. So clearly, if there is going to be a major impact on growth in the world, that will have an impact on us if we look out over the next year or two. But having said that, I think Standard Bank's lean and mean, and we've taken lots of preemptive action because of the last crisis.
I've noticed on your profit report here, very good one it is, but it says you're really focusing on Africa now. You've sold off the Russian and the Argentine assets, decided to focus on Africa. Is that a concerted move to get out of the firing line, or indeed potential firing lines elsewhere in the world?
No, not at all. We changed our strategy, had a really long, hard think about what we were good at, and in the aftermath of what happened in 2008 and 2009, said, look, trying to become a global emerging markets bank was probably a bridge too far for us. And we said we better concentrate on the things that we're really good at, and of course Africa is at the center of that. But we have been in countries like Russia and Brazil and China for many, many years in a very specialized and limited way. So we want to also connect Africa to the fast-growing economies of the world. So it's a tighter focus rather than a dramatic change in focus.
And you're happy where those other countries are in fact going? If you're not going to worry about the Europes and the Americas, and you're going to look at, and I think you mentioned 3 of the BRIC nations there, Brazil, Russia, India and China. You're confident that their growth is not just good, but sustainable, and that you will be able to be there for the long term?
Well, if you look at our business model, ICBC, which is the biggest bank in China and of course the biggest bank in the world, acquired 20% of us in late 2007. And so we are doing a lot of business between China and Africa in areas such as infrastructure, mining, commodities, trade, and so forth. So those countries are very important to us insofar as those types of issues are concerned. We're a little bit less concerned about the domestic growth of China, using that as an example. In Russia, we had a business there. We've been in Russia for many years. We've actually sold it to Sberbank, which is the biggest bank in Russia, and we will continue to have an office in Moscow, work with Sberbank on major mining and infrastructure transactions, particularly as they affect Africa. So those are just 2 examples, and a similar story around Brazil.
Okay, just a final thought from you, Jacko, if you wouldn't mind, and it is more of a personal one, actually. I want to try to get inside your mind and see what you thought of these markets in the past week, because we watched it in disbelief at times, the up and down nature of it all. You're a businessman, you're a financial man, a banking man. What were you thinking as people started to use these words again, the things like double-dip recession and global financial crisis number 2?
When you're sitting on the southern tip of Africa but have people and banking operations in many countries, of course, major dislocations really do concern you, because it's the unintended, unexpected consequences of what might happen and what you might read on the wires about a counterparty or a country at times like this. So of course, it's a time of fear, of intense managing of risks and watching for signs of some sort of contagion. But I think my overriding sense is that we're in for a longer period of slow growth in the world. Fortunately, we are somewhat, as a bank and as a continent, somewhat isolated from that. But nevertheless, the world is interconnected, and in the long term, we will all be affected if there is a double-dip recession. I sincerely hope that won't be the case.
Jacko Murray, it's been great talking to you there from Standard Bank in South Africa. Thank you for your time.
It's a pleasure. It's a pleasure.
So, Ali, Jacko Murray, they're sounding pretty bullish. He kept using this word isolated, saying we're isolated.
Yes.
While still acknowledging, of course, part of the global market. Is Africa that isolated, do you think?
Well, I think, that there was this theory in 2008 and 2009 that Africa was entirely uncorrelated from the West, and, you had to buy Africa as an uncorrelated asset, and that theory shipped a lot of water. If you go back to what happened to the stock markets after Lehman, all our stock markets fell quite sharply. That lack of correlation trade did not really take shape. I'm a firm believer in what Jacko's saying, but I think we've yet to decouple from the Western markets.
The fact that Africa has aligned itself, I'm using that word usually, but aligned itself more with China.
Yes.
That's got to be good for it to keep away from the Western ills.
Absolutely. And I think what Jacko was referring to in that interview again was about these new connections between the likes of Africa and Brazil, Africa and Russia, and Africa and China. And I think that's essentially what's driven Africa higher in the last decade, where we've seen a step change in GDP, we've seen an acceleration, and to me it looks as if we're now trending at a much higher level. So yes, I agree. I think, you know, Africa is the last great convergence trade going in the 21st century. We're talking a lot about commodities, but it's also about 1 billion Africans coming onto the global market via, I think, Kamal, via the mobile phone, which has created this great grassroots revolution.
Okay, let's move on and look at one of the other features of this market meltdown, and that's been the rapid rise in the price of gold, everyone's favourite safe haven in times of financial trouble. Midweek, we saw gold top $1,800 an ounce for the first time. As the markets waxed and waned, gold increased 8.5% in just 4 days for a total rise of 25% for the year to date. Now, here is a perfect case study of Thailand, where supply is actually outstripping demand. Such is the rush for gold. Veronica Pedrosa tells us more now from Bangkok.
In the heart of Bangkok's gold district, business is good. Everyone's buying whatever they can afford. In Thailand, owning gold is part of the culture, and it's been going on for years.
So it's not at all unusual for fruit vendors of apparently modest means like these to sink all their savings into gold. Sometimes, I've told, they'll walk in and buy bullion bars. So in here, what have we got? Maybe $100,000 worth of gold?
Yes, close to, yes.
Thanarat Pasawong is a third-generation gold trader.
In Asian countries, at least, most of them have a Chinese background. So Chinese, they believe in gold as something for luck. If you see every Chinese New Year, no matter how expensive the gold price is, the grandmother will, no matter how many kids she has, how many more grandchildren she has, she will buy it anyways for their kids every year.
The family business has scaled up and gone global in keeping with the times. Upstairs from the traditional retail shop, there are trading rooms for gold orders and futures. All kinds of gold-backed financial products to suit the needs of all customers. Even with gold hovering at all-time highs, they can't seem to get enough. This week, the room's been busy with hundreds of people hoping to make some money amid the global stock sell-off and currency interventions. One investment bank's predicting that gold will reach $2,500 an ounce by the end of the year. Around the world, there's a lot of anxiety about the financial markets and failing confidence in institutions. There's a strong sense that risks are high, and that's always when gold shines.
$2,500 an ounce by the end of the year. That sounds extraordinary to me.
Yes, I think $2,000 is a shoo-in. And if I can contextualize it a little bit for you, 1978, 1979 was the last cycle high in gold. We hit $850. You might not remember, but the Shah of Iran's peacock throne was being toppled by the Ayatollah Khomeini in Iran. That was coincident with that huge rally. When you convert that price into today's price, you come up with $2,400. Oh. So in that sense, that $2,500 call isn't such an outlier call. But for me, I think $2,000 is definite shoo-in. And I think what we've watched over this period, going back from 78, 79 all the way to today, is the debasement of paper currency. Who can trust any central bank at the moment? They all think they're wizards of the new age. They can print as much money as they want, but they really can't. So I think that's why people are reaching for something like gold, which cannot be debased. You know, you can't print more gold. There's a finite amount. So therefore, I for one see 2,000 as a definite trade.
Final quick thought from you then, Ali, about this whole past week we've seen. I've said it to previous guests, and you know, you'd wake up in the morning, or Doha time, you'd wake up in the morning and the Dow would have fallen 500,
That's
then
right.
it'd be down 6, and it was mind-boggling, the whole thing. What were you thinking as a market analyst?
Well, the first thing I was thinking of was you can only bet on the end of the world once. So as a bet, it's not really a good risk-reward bet. However, having said that, Kamal, the more I look at the market, the less I see that the policymakers have any options this time round. I think it's, you know, they've shot their bolt. They've tried everything. And I don't know what they can try now. That makes me very bearish. And therefore, I see a continued volatility and further downside risk at this moment in time.
Ali Khan Satchu, it's been a pleasure having you on
Thank you for having me,
Thank you so
Kamal.
much.
Thank you.
And that is where we'll leave you for this week. But a reminder, of course, to check us out online. If you start from the main page at aljazeera.net/English, hit the business tab at the top and then link on to our CTC page. You'll find all our episodes in full to catch up on. And then you can hop on Twitter and get in touch. At KamalAJE is where you'll find me for updates on the show and your chance to tell us what you would like to see on a future edition of the show. But that is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team and Ali Kansachu here in the studio. Thanks for joining us. The news on Al Jazeera is next.